New data from the Federal Housing Finance Agency shows U.S. home prices spiked by 0.5% in February. It also showed prices are up 4% year over year. Joining us now is the Director of Portfolio Strategy at Optimal Capital, Stacy. Frances, great to see you.
Oh, my goodness. What a pleasure to see you guys.
Yes, we missed you. We're so happy you're here to talk about this. So for people who might not understand, what does this number that was just out this morning mean for people who are looking to buy?
Yeah. Looking to buy. So we're not out of the woods yet. I mean, the thing is that I always tell people it's the same with bonds where yield trades inverse to price. What does that mean? So rates went down from over 7% to just over 6%. And that's going to cause prices to rise because people are calculating those things into the comps. However, and it's very interesting to see the regional dispersion here. But the thing is that you have supply and demand. Inventories are still very, very low. And then you say, well, that means that the price is going to go up. But you have to make sure that you have demand. Demand is going to remain incredibly tepid because how and where are the buyers going to qualify? We do have a softening labor market that's, quite a lagging indicator from the Fed tightening, and it's finally starting to roll over. Continuous claims are up 44% off the low. And then you've got this record amount of people with credit card debt. And not only that, but the interest rates on credit cards have hit record highs. And so these buyers are so subsumed with other debt service that it makes it harder and harder to qualify, even if rates have ticked down just a little bit.
And you mentioned what it looks like kind of across the map. And I remember early on the conversation we were having was about like some of these markets that got really red hot during the pandemic, like in the Southwest and stuff like that, and how they were looking very different than the rest of the country.
Yep.
Is that still happening?
Well, that's ameliorating a little bit. It's interesting that the Southeast is on fire and the West is sort of cooling a little bit. I think maybe it's what I think. It's that I like to be on East Coast time for markets and things like that. But, and banks are moving to Florida, and you look at those tax-free states, and it's interesting that Texas is still going up, Florida is still going up, and Nevada is still going down. But the thing about it is that the affordability is the thing to watch here, and the affordability is at an all-time low. It's even lower than it was during the global financial crisis, if you can believe that. Banks are still tightening in their lending standards. So first the Federal Reserve raises rates, they reduce the balance sheet, and then the lending comes in. After SVB, banks are more reticent than ever to lend. So this is just going to exclude more buyers. And then, of course, we've talked so much about the bifurcated economy. You've got the upper 40% who own assets, have collateral, maybe are able to borrow. And then you've got the lower 60% who don't really have $500 in savings and are living on credit cards. So those people, you just take that, you take those people kind of out of the demand equation, and then the math looks quite different.
Yeah, they're not going to be able to compete. It's like back to people who have money in the bank, have perfect credit, that are really going to be the ones competing for houses.
Yeah, that's for sure. So total housing inventory remained fairly low at by the end of March. So what kind of needs to be done to balance out the market to see more supply?
Right. So there are two ends of that, right? So the first end is people are reticent to sell when prices are lower. So you just get, you get people that are selling because they have to, not because they're trying to capitalize on these different, things that we've seen where prices have skyrocketed in certain areas. And then you've got, you do have kind of a housing shortage in different regions that has persisted. But the thing is that you think, okay, well, inventories are super low. That makes prices go higher. That's only true. It's not supply against price. It's supply against demand, which creates price. And so that demand part of the equation is so important. And I think that that's going to continue to fall off. Now, the Fed is still hawkish. I think they're going to raise rates again, which is going to, again, tick up those credit card payments for people. And I don't think we're out of the woods credit-wise because the assets that caused all the problems on the banking balance sheets are still on the balance sheets. And even though those banks were able to borrow from the Fed, they have negative revenue on those loans. So they're getting paid maybe 2 to 3% on those loans, and they are paying to service depositors and that debt at 4 and 5%. So we are not out of the woods. The big banks still have those assets on the balance sheet. The Fed has those assets on the balance sheet. The Fed is actually losing money for the first time in a really long time. They don't have a profit to turn over to the Treasury. So when you take all of these global macro concerns and all of these risks into play, you do see an uptick in these prices. You do think that rates are going to continue to go lower. The question remains, where's that demand coming from for the housing sector?
And like this spring is the hottest time for the housing market, right? This is as good as it's going to get. Frances, Stacy, thank you very much.
Thanks, guys. Nice to see you.
Good
nice
to
to
see
you too.